standard costing, and variance analysis. Again, it's prepared and presented by Mr. James. First, we'll look at the definition of the terms. There are 4 technical terms that you'd come across. First one is standard cost. A standard cost is a predetermined or budgeted cost. This means that the management set the cost of the various elements of cost as a standard, and then they work towards achieving that standard. Standard costing is the setting and use of standard costs in managerial accounting. A variance is the difference between a standard and an actual cost. Okay, so the difference between the standard that you set here and the actual outcome. And variance analysis is the calculation and use of variances in managerial accounting. Okay, so bear that in mind when we come across and use those terms. Standard costs, they are benchmarks or norms for measuring performance. In managerial accounting, 2 types of standards are commonly used. You will see other types of standards, but they all can be broken down into quantity standards and price standards. All right, quantity standards would specify how much of an input should be used to make a product or provide a service. Okay. Management does these specifications, and they will determine how much material, labor, and overhead should go into producing a product or service. And the price standards specify how much should be paid for each unit of the input. Again, management would specify how much they would pay for the materials, labor, and overheads. Examples of businesses, major businesses that uses standard costing, Firestone, that's the tire company, Sears, that's big retailers, McDonald's, hospitals, constructions, and manufacturing companies. Okay. I'll look at standard costing. This here should be standard costing. I will change it. All right, you have the amount of the 3 elements of cost here: direct labor, direct material, and manufacturing overhead. And any deviations from this standards that management has set here would be looked into. It is brought to the attention of management, and this practice is known as management by exception. Only the ones that deviate from these standards, like in this diagram here, you see direct labor was within the standard, as well as the overhead, and but the materials went over, all right, over the budgeted amount, over the standard. So management will look into that to see what caused it. The purpose is not to attribute blame to people, but to find out what is the reason for that. It is so that it could be corrected. A variance analysis cycle. First, you prepare your standard cost performance. They call it a report here, but actually it's the budget that will start with. And when you get the actual, you will analyze the variance compared to the budgeted figures here. And you'll identify any questions. All right, so you don't check into the whole thing, only, as we said, those that vary or differ from the standard. You would identify those and get explanations from the persons who are responsible for it, and see what corrective measures you could take and get ready for the next period's operation when you start the process all over again. You have two types of standards. One is ideal standards. These require that employees work at 100% peak efficiency because it's ideal or perfect, and the conditions also must be perfect, right? And then you have practical standards. They are attainable with reasonable efficiency and effort. Okay, so you rarely ever have businesses setting ideal standards, because if the employees don't work at peak efficiency, usually conditions are not perfect. Sometimes you have breakdown, shortage of material, shortage of labor, employees go on strike or whatever. But the conditions are not perfect, so it's pointless really in setting ideal standard. Most people use practical standards that they take into consideration that employees might strike, prices of raw material might vary from what your budget and things like that. It's setting direct material standard. Like I said, we had price standards and quantity standards. Okay, the price standards, it would be set by the purchasing manager who purchased the raw material. He will check around and get an idea of what the raw materials costs after discounts, and he will set the price standard. The quantity standards, on the other hand, cannot be set by this guy here. They must be set by the someone in the factory who knows how much material go into producing the product, or how much labor and overheads, conversion costs goes into it. So most likely here you're going to get some supervisor or engineer from the factory setting the quantity standard. Direct labor standards, rate standards, again, you're going to rate, this is actually a price, and the efficiency has to do with quantity again. So although we're calling it rate because you pay labor hourly rate, and efficiency of labor is measured in efficiency rather than in quantity. Okay, so that's just arose by a different name. So the persons involved here would be a different manager from here. Okay, um, the rate would be negotiated by some supervisor in the office with the union, the workers' union, and here the efficiency is determined by, again, someone working in the factory, a supervisor or a manager there, how much time you're going to take for each operation. For the manufacturing overhead variable, the fixed rate, again, the rate is usually the POHR, right? The variable portion of the predetermined overhead rate. And we saw that in absorption costing already. The quantity, again, would be determined by the allocation base. So these really don't have much to do with the manager, except the determination of what the allocation base would be. Right. So price and quantity standards are determined separately for two reasons. The purchasing manager is responsible for raw material purchases prices, and the production manager is responsible for the quantity of the raw material used. And this would apply for labor as well. The purchasing manager is usually in admin, and the production manager is in the factory. So you have to have someone down here in the factory who knows about the production, and whereas someone in the office will see about the actual purchasing and ordering. The buying and using activities occur at different times. Raw material purchases may be held in inventory for a period of time before being used in production. Okay, so two reasons why different people do it. And the general model for variance analysis is price variance, quantity variance. Okay, this is the difference between the actual price and the standard price. If the actual price is greater than the standard price, then you have an unfavorable or sometimes they call it an adverse variance. Okay, if it's the other way around and the standard price is greater than the actual price, it means you have a favorable variance. And same with the quantity variance, the difference between the actual quantity and the standard quantity. Okay, so the variance really is the difference between the actual and the standard or budgeted quantity. Okay, again here, if the actual is greater than the standard, then you will have an unfavorable or adverse quantity variance. And if it's the other way around, then you have a favorable. Okay, you could have three different price variance, the material price variance, the labor rate variance, and the variable overhead rate variance. We call these rates because they are actually a rate, the hourly rate for labor, and the overhead absorption rate for overhead. But they are related to the price of the element, of course. And this here, quantity variances could be divided into materials quantity variance. This is where the actual would vary from the budgeted, and the labor is a efficiency variance, so too is the variable overhead. Okay, so the variance is the difference between the actual and the budgeted, and the price variance and the quantity variance will make up the total variance. So you can have a total variance for materials, for labor, and for overhead by adding the relevant price and quantity variance. Yeah, general model for variance analysis. All right. When you actually carrying out the multiplication and the minusing, you can use this here. The first column is done this here. 1 column, 2 column, 3 column. All right. Then you take this here, will give you this from this, will give you the price variance. And this from this gives you the quantity variance. If you add these two together, you'll get the difference between this and this. Okay, now the procedure for going about it is to do this column first, and then do this column first. Next. Then you do this column. Okay, then you can get these. So when you do this one and then this one, you can get the total variance, and then you work out these two, you can balance it with the total variance. Okay, now in addition to this, you can, okay, the actual quantity is the amount of direct materials, labor, and variable manufacturing overhead actually used. Okay, so actual in both columns, and standard in the other column, right? The standard quantity is the standard quantity allowed for the actual output of the period. Okay, this doesn't really say anything. Standard quantity is the quantity allowed for the actual output of the period. Okay. Right. Actual price. Actual price is the amount actually paid for the input use. Okay, so this takes place after production has started. And the standard price will take place before production has started. Standard price is the amount that should have been paid for the input use. Okay, so you may budget a price here, but when you actually start to produce, you use a different, you get a different price for the raw material, the labor, or the overheads. Right. In addition to doing it like that model that we just used there, you can use the formulas. Okay, AQ is for actual quantity, SP is for standard price, AP is for actual price, SQ is for standard quantity. So you can form them into an equation like this. Now in this equation, here in this expression here, you can take out the common factor AQ, and we can leave the other two inside the bracket, right? So you'll get AQ outside the bracket and AP minus SP inside the bracket. Okay, so it shows you that the price variance is the difference really between the actual price and the selling price. Same goes for the quantity. You can take the which one you can take the price out, and you will remain with AQ and SQ inside the bracket. So AQ minus SQ multiplied by the standard price, right? So it shows that the quantity variance is the difference between the actual quantity and the standard quantity. So that is one way of remembering it, okay? But at first, what you may have to do is memorize them, right? And as you begin to work problems, you would see the logic behind it and you will be able to remember it. But you have to memorize these or something. They are not given to you in the exam. Okay, so that basically is the end of the lesson. We want to look at how we will compute some of the variances, or all of those variances that we talked about just now. An example, material variances. Glacier Park Outfitters has the following direct material standards for the fiber fill in its mountain parka. Whatever that is. 0.1 kg of fiber fill per parka at 5 per kg. Last month, 210 kgs of fiber fill were purchased and used to make 2,000 parkas. The material costs a total of $1,029. So let's look at what we have here. We have here the budgeted or standard cost, right? This is the quantity, 0.1 kg, and this would be the price. Okay. On this part here, we would have the actual. Last month, 210 kgs of fiber fill. So this is the actual quantity, and we are not given the actual price per unit, but we have the total here. So if we divide this by the 210, we should get the price per unit, okay? So that's what we have there, summary of the variance, actual quantity by actual price. There are 210 by 490. 490 is the price you will get when you take the 210 and you divide the 1029 by it. Okay, you'll get 490 per kg. Actual multiplied by the standard price, but we said you work this column first, and then you work this column next, and then you try to.
So,
yeah.
The actual it was $5 per 0.1 kg, right? Not one.
Yeah. Are we looking at the total purchase here? Right, that is the amount used.
All right.
Okay. So the standard quantity by the standard price here would be 200 by 5. This is what should have been used, right? This is what they purchase, and this is what is actually used. Okay, we got it? Okay, I'll go over that over. This here, the standard by the standard, this is what they budgeted, right? This is what they purchase, and this is what they actually use, right? 210 by 5 gives us 1050. All right, now the difference between here and here is the price variance, and the difference between here and here is the quantity variance. All right. Now, all we have to do now is determine whether it was favorable or unfavorable. If the actual, we say, is greater than the budgeted, then it is unfavorable. In this case, we have an unfavorable quantity, right? So the quantity variance of $50 is unfavorable. If the price works the same way, we have a favorable price. We paid this, which we should have paid that. Okay, so we have $21 favorable. When we add these two together, we will get the difference between these two. Okay, let's look at it with the formulas. We can use the formulas that we had there. The material price, the actual quantity, multiply by the actual price minus the standard price. So it will be 10 to 10, multiply by 490 minus $5. Notice the actual is less, so it's a favorable. 210 minus, multiply by minus that is just $21 favorable. We don't put negative money, okay? You put the F to show that the actual is less. Materials quantity variance, again, we use the same formula, but this time the quantity is going on the, sorry, the price is going on the outside and the quantity on the inside. And we work it out again, we get our 50. When we add these two together, we'll get the total material variance. Okay, or you could put the two formulas together, this and this, and get the total materials price variance. Okay, so that's an example of calculating the price and the materials variances. Now, as we said, they're going to investigate that. The materials quantity variance would be the responsibility of the production manager, and the materials price variance would be the responsibility of the purchasing manager. Okay, the standard price is used to compute the standard price is used to compute the quantity variance so that the production manager is not held responsible for the purchasing manager's performance. See, looking at direct labor variance, again, please see Peak Outfitters has the following direct labor standard for its mountain packer: 1.2 standard hours per packer for $10 per hour. And last month, the employees actually worked 2,500 hours at a labor cost of $26,250 to make 2,000 packers. Again, we can get the hourly rate here, the actual rate, right, by dividing this by this. So you have all your information there. You can come and fit it into something like this again and get the rate. You wouldn't call it a price because you're dealing with labor, and you wouldn't call this quantity either. You don't usually normally speak about quantity of labor, but you talk about efficiency of labor. Okay, or you can use the rates again. The equation and work it out again. You get your favorable and unfavorable. Both of them are unfavorable this time. If so, you can add them together and you will get your total variance. Again, the responsibility is with the production managers, and it depends on the mix or skill level assigned to work task, the level of employee motivation, the quality of production supervision, and the quality of training provided to employees. So these are the reasons really why you have variances. To compute the variable manufacturing overhead rate and the efficiency I missed a slide there. Right. We have again place your peak cutters are the following direct variable manufacturing overhead labor standard for it. Okay, the word labor there not supposed to be there, right? For its mountain packer. 1.2 standard hours per packer at $4 per hour. Again, this would be your standard cost. Last month, the employees worked 2,500 hours, actual hours, to make 2,000 packers. Actual again, actual variable manufacturing overhead for the month was 10,005. Okay. So let's go back here a minute. You can get the rate by dividing this by the hours, because it appears, since we are given no other hours, that they are using direct labor hours to allocate the overhead. Again, we work out this column, then we work out the middle column, and the difference between these and these would give us our rate and our efficiency. Variable manufacturing overhead could also use the formulas. You notice it's the same thing, it's just the letters changing. Okay. The fixed overhead variance has a difference. You can compute the spending variance, how much, and you can volume variance. Okay, this depends on the quantity you produce and sell, and this one depends on the amount that you spend. Actual budgeted figures for a month, the fixed overhead was actually 122,000. The budgeted was 120,000. Machine hours 5,100. Budgeted 6. Production units 10,000. Budgeted 12,000. The POHR is 20 machine hours per unit. So to get the amount applied for the month, you would use the machine hours, which would be 6,000, and the budgeted, that is how you get the $20 per hour. You divide this by this, and you get your POHR. Okay. The FOSV would be equal to the total, the actual total minus the budgeted, and we get 2,000. It's favorable because no, that shouldn't be favorable, right? Because the actual is greater, right? So it shouldn't be favorable. This should be unfavorable. And then you have the fixed overhead volume variance, 120 minus the 10,000 hours multiply by $10. If you are 100,000 from this, you get $20,000, and it would be again unfavorable, right? Advantages: it allows management by exception. We explained what that was. It simplifies your bookkeeping. These are what the textbook says and what they expect to. But of course, we may disagree with this. Promotes economy and efficiency. This could be so, and it enhances responsibility accountability. Problems with it, right? Emphasizing standards may exclude other important objectives, right? What the tendency is for employees to look towards achieving the standards and not performing any better. Standard cost reports may not be timely. It takes time after you finish produce to analyze the results. And invalid assumptions about the relationship between labor costs and output. Favorable variances may be misinterpreted. Emphasis on negative may impact morale. Okay, if the management, top level management especially, place too much emphasis on negative standards or negative results, the impact could be on the morale of the employees. Continuous improvement may be more important than meeting standard. Okay, so that brings us to the end of this presentation. It was a bit quick in the end there. So we have over a minute remaining if you have any question.